Okay, I've been trading 7+ years. Only trade YM, trade 8 a.m. to 11 a.m. Eastern Standard Time, and I give myself 3 shots a day to get a trade off. All right, so today I'm just gonna briefly explain to you liquidity before we get on the charts and actually look at some examples and show you the type of liquidity that I look for when I take trades. Just gonna kind of make a little explanation, give you a kind of a simple explanation. This is probably gonna be one of the most simplest liquidity-based videos you ever watch, right? So. Understand that liquidity refers to the volume of buy and sell orders resting at a given price level in the market. All right. These orders come from real participants, retail traders, institutions, algorithms, and things of that nature, all placing stop losses, pending orders, and entries at levels they consider significant. Right. Prices drawn to areas of high liquidity because that's where the volume exists to actually fill those large orders. Now, to make that a little simpler, understand that liquidity is just let's just say parked orders in the market, okay? And waiting at certain price levels. Every high and low typically essentially is orders just stacked up there waiting to get triggered, right? The market doesn't move randomly, okay? And you need to understand that it moves towards these piles because that's where there's enough volume to push price through. In order for the market to move, it needs liquidity. So the premise of my strategy and the way I trade is called take and target. The market takes liquidity and it goes and targets liquidity, using the liquidity it just took as fuel to then fuel the next direction to go and target and take more liquidity. And this is a never ending cycle of that, right? So understand from that price goes to where these orders are and not to where you think it should go, which is why I have liquidity as like the first thing in my strategy. So let's get into it. So right here we can see when you see things like this taking place at 9:30 open. I mean, it's obvious. We took liquidity from yesterday. It's high. We took liquidity from Asia, took liquidity from London. We tapped into this brief situation here that took place yesterday, right? This is one form of yesterday high is a form of liquidity. Asian high, London high is a form of liquidity. When you see a candle with a massive wick on it, or just a wick on it in general, like this candle here, this candle here, this candle here, right? Understand that these candles can be considered single candle order blocks. Why? Because they are sweeping liquidity. They're sweeping the previous candle to the left as well as a general area that they're also sweeping, right? So we can see here the yesterday high was taken, and this is actually a trade I would have taken. 9:30, that's one of my macro entry execution times. 9:30 open, came up and swept Asian, swept yesterday high, and this candle here is actually a single candle order block as well because this candle swept the previous candle. Understand that with a single candle order block, can be used as a supply or demand zone. Okay, so here we have a single candle order block taking out yesterday's high, tapping into a supply from the left, also taking out Asian and London, and then reversing the market to the downside, right? So this is something you will see often in the markets, just based on kind of how I trade. These are the type of trades I like to take. Over here, you can see that this candle from London swept the previous few candles here, took liquidity. It also mitigated this supply zone here. If I was to actually go to the higher time frame, this area, these two candles, the way they're significantly placed, this is another single candle order block. It's a wick on the higher time frame, right? This candle here, 9:30 candle, swept the previous candle. Again, this is taking place at 9:30. So this is why liquidity is very important, because I need to see liquidity actually being taken out before I consider taking a trade. Okay. So same thing you can see happening here. What time is this? This is 9:45, still within the execution window. Okay, 9:45, taking out London. All right, sweeping liquidity from London here. It's the same thing, okay? And we go here. What time is this? 9:45. Sweeping the highs of these candles into this supply zone here. So this is a supply, okay? So you always want to see liquidity being taken out. It's the reason that this candle at 10:45 came down and swept just barely below these lows, which was actually the low of this day before reversing back up, okay? It's a reason for that. So liquidity should be the premise of why you trade. For me, it definitely is the premise of why I trade and how I go about taking trades. Liquidity being swept here by New York. What time is this? 9:30. Happening at that hot time when I actually look to take trades. Okay. Market goes all the way up. They sweep London. And you can see this stuff clear as day. It's happening. Liquidity is being taken. And it's not just the places that I'm highlighting that liquidity is only being taken in these specific places and areas. It's a lot more places it's being taken as well, but these are just the significant ones that I'm paying attention to because these are kind of like the times that I look to actually execute trades. All right, so sweep here. Cool. At this point, since this candle swept the previous, it is a single candle order block. It can be treated as a demand zone. As you see, the market comes back into the demand zone right at 9 o'clock before it reverses up, right? Massive fair value gap here. We can see that we actually got a close above London. Once market closes above London, left a massive fair value gap. The market comes right into that fair value gap and reacts to it the next day before it reverses up. Didn't sweep the high of Asia here, but actually did. This is a sweep. This candle swept the previous candle over here. So this can be used as a single order block. This is the same thing over and over. Liquidity just needs to be the premise of how you trade. It's the very thing that actually makes the market move. So trading without liquidity in mind or being your primary focus is just not going to be as beneficial as you may think it will be. So, I mean, those are just some brief examples of liquidity here. Liquidity being taken out and the market reacting to that. So liquidity here, these lows here, taken out. You can see because we swept the lows, then closed below, swept it in reverse, came up, swept out London here. Same thing. So yeah.